Welcome back, investors, to Ticker Time News. I am Adam, and the stock market logged decent losses today on this options expiration day following a big earnings warning from FedEx, ticker symbol FDX, who, by the way, lost 21.4% of its value just today alone from their warning. More on FedEx in just a moment. Now, the major indices all closed near session highs today. There was a little bounce there at the end of the day, but they failed to climb out of negative territory. This marks the fourth losing week out of the last 5 weeks. The S&P 500, it closed down 2.1% on the week. The Nasdaq Composite closed down 5.5% on the week, and the Dow Jones closed down 2.2% on the week. Now, let's quickly talk about the major indices, and then I want to talk about FedEx and their warning for just a moment. Okay, Spx and Spy. They were off a little bit today. They're usually in pretty good sync, but today, SPX, which is a measure of the S&P 500, it was down 0.72%, while the SPY, which is also a measure of the S&P 500, but it has a lower volume rating. It also has a less money flowing through it as compared to the SPX ticker. But the ticker SPY was down 1.17%. So about, a quarter of a percent difference between the two. That is odd. And that was mainly due to the options expiring today, which caused a lot of volatility and volume spiking big time for today. Just look, this is the daily view on the chart right here, right? And this is the SPX. And you can see the volume down here, the red and green waves. The last time we got a big wave of volume was the June 17th low. And then today, we got a big jump in volume. As a matter of fact, here's how volume came in today for SPX. It was 4 billion transactions. 4 billion transactions on SPX. You know what the average is right now from the past 30 days? It was 2.2 billion. That's the average, but we had 4 billion trades taking place today. It was phenomenal. Great start today, then shop. Absolutely. And we can see that. I'm going to go to the 5-minute view here for the SPX, and then we'll hop over to the SPY. Ignore the purple blob for just a moment. This kind of marked, nearly perfectly us getting back to 3,900 level. But today is what is on the chart here. The big drop down this morning kind of chopped around after that drop down, and then things kind of changed around 2 o'clock Eastern time, and that's when the market started to turn things around. The options business was pretty much over, and the market began to rally. So if you held on to shorting the market like SPXS, for example, all the way up until the close of business today, you would have been up about 18 to 19% on the week. But a couple of points get taken away there on the weekly total because of this little rally here at the end of the day from about 2 p.m. on to the close. There was a bit of a rally there. But I do find it interesting. Even though there was a rally at the end of the day, if we look at, and let me get my trusty little highlighter out here, once we dropped this morning, right? Once we had this gap down this morning, the high was reached again right here for the day. And again, not at the close, but earlier this morning. And this high right here was 38.73, 38.73. And then we get to a few highs here at the end of the day. The highest being 38.37. Isn't that interesting? The high this morning after the drop, 38.73, and then we get to this afternoon, we get 38.76. Another one, 38.76 again, 38.77. So there seemed to be a lid on any rally, whether it was this morning's little comeback or the rally into the close. There's this ceiling around 38.80. Just call it like that. Nice, easy number to remember. 38.80, there was a ceiling. Will this ceiling persist into next week? And I want to share something with you. Let me pull it up here right quick. I've got too many notifications going on here. Hold on, almost got it. And it's important to this conversation right here. Okay, let's see. Okay, here's what I want to read to you. This is from Stock Traders Almanac, okay? Which it's a fabulous buy each and every year. Tons of seasonality insights for the market. But they say S&P 500 down 25 of 32 week after September triple witching. Average loss is 0.89%. Stock Traders Almanac, page 101, see pin tweet, discusses aurora of the triple witch, when options, index options, and index futures all expire at the exact same time, and this happens 4 times a year. It's usually followed by increased volume and volatility, the double V's. We got increased volume today, and we got increased volatility. All right, now there's one other thing I want to read here. And this comes into play about this 38.80. Can the market break back above that next week or anytime between now and the end of September? Listen to this. The week after September options expiration week. Okay, so that starts Monday through the end of September. Has a dreadful history. A dreadful history of declines, most notably since 1990. Substantial and across-the-board gains have occurred just 4 times since 1990. 1998, 2001, 2010, and 2016. Those were the 4 times the S&P 500 saw significant gains after today. The majority of the time, there are sizable losses. So that does not sound very good for Monday through the end of September. Remember, last week I said that the second half of September is usually one of the hardest times to trade because of the volatility. Well, it's not just volatility that's going to hit us. If we go here, I'm going to go back to actually, let me clean this chart up here right quick. Just get these highlighter marks off. Keep it nice and clean. If we go back to the daily view for just a moment, let it load here. I want to show you this real quick. I'm going to slide over here. These gray bars, there's 1, 2, 3, 4, 5. Okay. We have one here, one here, one here, here, and here. All of those are gaps. Okay. And all gaps get filled. Well, we have 3 gaps above us and we have 2 gaps below us, right? From this, call it 38.80 point on the chart. Now, from the candlestick that was made today, which happened to fall nearly perfectly within my blue circle here that we made over a week ago, to the edge, the right edge where the highlighter started on these gaps right here, that's the end of September. So if the back half of September, and especially after options expiration, which happened today, if starting on Monday, if it is dreadfully in the gutter, does that mean from today's candle until the end of September, we're going to cut through that 3,900 level and sink even further, it kind of seems like that's what they're saying based on the historical data, and especially since 1990. Now, of course, past returns are not a guarantee for future returns. So we do have to keep that in mind. We also have to keep in mind that there is a big boogie monster under our beds, and it's going to jump out next week, and that's the Fed. The Fed is going to jump out next week, raise interest rates, what looks to be 75 basis points at this moment in time, and that could cause more pain in the market. Plus, you cannot let go of the fact that Jerome Powell, when he gave his Jackson Hole speech, which was this big doozy of a red candle right here, he said to expect pain, not just consumers, but businesses. And if businesses are to expect pain, well, that means that there needs to be a revision of earnings estimates, and they need to be revised down. That has hardly happened. That has hardly happened at all. But one company stood up and said, you know what? We need to be honest. We need to tell the truth. And that was FedEx today. That's what FedEx did. FedEx warned us about their earnings, and they downgraded their estimates. That's what so many other companies are going to do from this moment forward. Let's look at FedEx real quick. But first, I did promise also to look at the SPY and the Qs. So let's do that real quick. All right, so SPX Daily View. Now we're going to go to the SPY Daily View. And remember, the SPY was down more than, on a percentage basis, than SPX. And the SPX is exactly what the S&P 500 was down today, 0.72. But SPY was down 1.71. Now, volume, remember, on SPX hit 4 billion today. 4 billion trades taking place on SPX. On the SPY, 103 million. 103 million. The average volume on SPX was 2.2 billion. Remember that? The average volume on the SPY is 78.8 million. So it was still higher volume even on the SPY today at 103 million. So just wanted to show you that difference in volume between SPX and SPY, because there was a big discrepancy in the percentage loss between the two today. And it all came down to options. All right, let's keep moving on. Looking at the Qs. Oh, and one other thing I want to point out here too is the SPY and the SPX, both representing the S&P 500, are below a declining 5-day EMA. It was a rough week. They're also below their 50-day moving average. They're under their 200-day moving average, and they're under their 20-day moving averages. So all of their important moving averages, they are under, and all of them, all four of those averages are declining, which is pretty simple to understand because the stock market was declining all week, it seemed like, right? It was a rough week. All right, let's hop over to the Qs. And one other thing to note, the weekly expected move, it was crushed this week. It was crushed this week. You can see the S&P at the SPX closed down here at 38.73. The lower end of the weekly expected move, 39.70. Let's look at the SPY and the weekly expected move. This is telling me that the options market, which is the most efficient part of the markets altogether, is being inefficient right now. And it's because of the volatility and the, I don't know which way we're going to go, right? Mentality of most market participants. Now, we here on the channel, and you too, we have a pretty good understanding that we haven't seen the bottom yet. And the market will continue to fall, and there will be pain in the market. So looking at the SPY weekly expected move, it closed at 385. The lower end of the weekly expected move was 396. Now, when we look at the Qs, it'll be a little bit different. Do you think the market will rally on the 75 basis point rate hike on Tuesday, since it's already known and priced in? I do believe some of the 75 basis point rate hike is priced in. I do believe that. And if we were only getting a rate hike and we were getting nothing else, no Jerome Powell speech, then I would say yes. But the wild card is Jerome Powell. And I was asked a little while ago on a live stream whether I thought Jerome Powell's speech last week or earlier this week, now I can't remember, whether or not that speech would affect the market. And I said no, because I felt that Jerome Powell, he was only going to reiterate what he said right here when he was giving his short, blunt speech at Jackson Hole. I thought for sure he wasn't going to say anything new, because he laid it out on Jackson Hole, and that's why the market fell so hard that day, 4.1% on the Qs, that there was nothing else for him to say, just to back up what he already said. Now, next week, this is an opportunity for him to say something new. I do not think that he's only going to reiterate what he already said at Jackson Hole. I do believe he will add some new context to what he is saying about the pain that is to come, and about how hawkish and how aggressive the Fed will need to be. So that's the wild card. So just to sum up to your question, my answer would be, if it was only a 75 basis point rate hike and that was it, nothing else, then yes, I do believe the market would rally from that, because I do believe that portion of September the 21st has been priced in. But the wild card is what Jerome Powell will add to what he said at Jackson Hole. That's what could sink the market further. Okay. I know that's not a perfect answer, and it's almost a, well, it could go either way, but I am firm on the rate hike, that the rate hike is priced in. But the concern about what Jerome Powell may add to what he said at Jackson Hole is the wild card that may catch the market off guard. So I hope that answer is thorough enough that it can give you some confidence in knowing. And I know it's not a perfect answer, but it's not a perfect situation on the 21st. Okay. Weekly expected move for the Qs. And let me just take this arrow off of here. The Qs closed at 289. It's up a little bit in after hours, back up to 290. And remember, 290, that's a critical level. That's like 3,900 and 390 for the SPX and the SPY. 290 is that critical area for the Qs. So I do think we could get a bounce come Monday. I do believe that. I do believe Monday could be a green day. Now, the weekly expected move was 297. So $7 shy, $71 shy of the lower end of the weekly expected move. I remember we got our first 75 basis point rate hike and we sunk. The second time we celebrated. So I'm just curious to what the market might do. Yeah, absolutely. We are all curious, my friend. We are all curious. But I do think, thinking about it this way, that the 75 basis point rate hike is priced in, okay? Part of what Jerome Powell may say is also technically priced in because of what happened on Jackson Hole and that big red day. But there is still that wild card that Jerome Powell, whatever it may be, whatever he adds to the Jackson Hole speech, that will be the determining factor on whether the market rallies or the market sells off. And I'm sure as soon as he starts speaking, because of the press release that comes out 30 minutes before he starts talking, I'm sure that's going to get the market going up and down and up and down. Very volatile. I probably won't even trade that day unless I can catch maybe something. If I see a trade, if I see momentum moving in one direction or the other, that's very convincing, then maybe I would hop into that. But as it stands right now, I will not be trading on the 21st, especially in the morning. All right. Stay curious too, my friend. Stay curious. So again, we got that wild card with Jerome Powell and what he may say. Okay, so a discrepancy here on the weekly expected move. When we go to the IWM, which is the small caps, down 1.45% today. Pretty big drop for them. However, they were a little bit closer to their weekly expected move. And as a matter of fact, if we go back to last week's weekly expected move, that one actually lines up much better than where the weekly expected moves lined up today for this week, right? Okay, so IWM, small caps, it closed 178. In the after hours, it's up to 179. That 180 is important for the IWM. Now, the lower end of the weekly expected move was 181. So not that far off, but it did miss. And remember, the options market has a 68% win rate. So it's pretty significant when they miss. And it's just showing an inefficiency in the market right now, mainly due to the confusion, the volatility, the head bobble for the market. Okay, let's talk about FedEx for just a quick second. Ticker symbol FDX for FedEx, again, down 21.4%. What FedEx did today is what many companies are afraid to do because of what happened to FedEx, losing over 20% of its value in a single day. You have analysts coming out saying, don't buy this dip for FedEx. Man, that is rough. Okay, here we are, the daily view for FedEx. You can see the past couple quarters, it's really just been range bound, even going back to September of 21, range bound. So hasn't been moving a lot. And if you study Dow theory, you understand how important a company like FedEx is to Dow theory. And with FedEx dropping like this, it's rough. I mean, Dow theory is basically using Dow Jones Industrial Average versus the Dow Jones Transportation Average. And using those two as kind of like indicators, you can tell when we are at the bottom of the market or we are at the peak of the market. And right now, this is shooting further down saying, hold up, we have not reached the bottom yet. Dow theory says that there's more pain to come. There is more of a bottom left in this market. So Dow theory, that's something very interesting to look up and to read through if you haven't heard about it before. But FedEx sinking like this, it pulled Dow Jones transportation down heavy today, which of course affects Dow theory greatly. Okay, so FedEx, they issued a bleak earnings warning for its fiscal first and second quarters, which set the tone for the entire session today. The entire session for the market. Why the market dropped so far was solely on FedEx back, almost solely. It had a big part to play in today. The company cited worsening macroeconomic conditions, both internationally and in the U.S., as the reason for its warning. This added to existing concerns about rising inflation, rising interest rates, and a potential hard landing or crash that have been weighing on the index performance all week. Now, this warning, I think, is something many companies are too afraid to say. I think there are so many companies out there that need to give revisions on their earnings estimates, and they're afraid to because they are seeing it looking bad as well. But they have a responsibility to their investors to be clear, open, transparent, and announce when a revision needs to be done to their earnings estimates, whether up or down. And I think there are many more in the wind waiting to drop. Now, that's about as far in as I'm going to go on FedEx. It is rough for them. It is shocking, and it affected the market today. But the selling, all right, I'll hold off on my next thought here for just a moment. A lot of people tried to write off. Let's see. Let me put it up here on the screen so we can all recognize this. A lot of people tried to write off the FedEx thing as FedEx internal issue. Denial, but these estimates are coming down sooner or later. Amen. Denial is a great word to use in the context of this market and in the context of market participants all across the world engaging in this market. There are so many companies out there that have yet voiced their concerns about needing to revise their earnings estimates lower. And I don't know what they're waiting for. I say rip the Band-Aid off. Come out, be clean and transparent about what you're seeing. And don't just hope that, oh, well, maybe, maybe in the final month of this quarter, things will get better. So maybe we'll just keep it quiet for now and don't tell the public about our earnings situation. That could be a conversation, a legitimate conversation around boardrooms all over. That maybe they're hoping that the final month of the final quarter, things will improve. I don't know. I'm just taking a big guess there, but it's a possibility that That's a reason. Maybe they're hoping that the Fed is still their friend and the Fed will step back in and do a, quote, pivot and help them out. I'm sorry to say, but there will be no Fed pivot in 2022. Now, how aggressive the Fed will be through the rest of the year, we've got the September meeting, right? And we're all feeling pretty confident that that will be a 75 basis point rate hike. As a matter of fact, let's just all go here. Let's just all go here to the Fed Watch tool, the CME Fed Watch tool. We've got September the 21st. And I haven't done this before during a live stream, but I will do it this time. There is a, there are forecasts for other months as well. So if we look here for the September 21st decision, right now it stands that we are at an 82% probability of a 75 basis point rate hike. There is currently right now an 18% probability of a 100 basis point rate hike. So the market to me is saying that we're 100% sure we're going to get a 75 basis point rate hike or greater. That's what this is saying to me, okay? And if I just scroll down here just a little bit, and if we look here on the bottom of this, it says 1 day ago, 1 week ago, and 1 month ago. 1 month ago, it was only a 41% probability of a 75 basis point rate hike. And it was a 59% probability of a 50 basis point rate hike. So in the span of 1 month, the probability of a 75 basis point rate hike has doubled. It's gone from 41% to 82%. The 100 basis point rate hike in that percentage only popped up within the past few days. And right now it stands at 18%. I do not think we'll see that. Now, our next one is November the 2nd. And if I look on this chart here for November the 2nd, you can click on that and you can see the probabilities here. Okay? So we have a probability of a 50, a 75. Wait, let me double check this real quick. I need to write down these numbers. Give me a quick second. September 21st, 75. That would take us to 3.00 to 3.25. Okay. All right. Now let's go to November the 2nd. That's the next time Jerome Powell will come out. So we're going from 25 to 50. All right. 30 to 50, 20. Okay, so we have 50 basis point rate hike is the probability to the left. That's at 35.2. The one in the middle, which is a 54.5% probability of a 75 basis point rate hike. And again, this is November. And then there's a 10.3% probability that we'll get a 100 basis point rate hike in November. So even right now as it stands, the highest probability is sitting at 75 basis point rate hike in November. Okay? In November, they're still set at that. So let me write this number down. That if it was another 75 basis point rate hike, that would take us to 3.75 to 4%. And there's still one more meeting this month. This year, December 14th. December 14th. Now, this one's interesting. It's a little more spread out, okay? So we could potentially be going, let's see, 75 to 400. Okay. So we have 25 basis point rate hike, 50 basis point rate hike, 75 basis point rate hike, 100 basis point rate hike. So right now, the probability is kind of split 50-50 between a 50 basis point rate hike and a 75 basis point rate hike still in December. That's pretty amazing. That September, November, December, we could get 3 more 75 basis point rate hikes, and that would take us to 4.5% by the end of the year. The Fed's fund rate could be at 4.5% by the end of the year. This is the fastest rate hike in history. And that speed at which the rate is going up could continue. It could continue. Now, that's through December there. That's the next 3 meetings. So where do you think we're going to fall? Could it be that we go back to a 50 basis point rate hike in November? It's possible, but right now it's not looking likely, right? So I just wanted to show that to you, and because I haven't clicked through those before to show it on a live stream before, so I wanted to give you guys what the market is looking for or looking at as we go through the next 3 meetings: September, November, and December. There is no FOMC meeting in October, so just keep that in mind. All right, let's see here. Would rate hikes affect rents? Yes. Let's do this. Let me go over here. First, let me do this so everyone knows what we're talking about here. And then I'm going to go over here, and I'm going to go to the 2-year Treasury, US 02Y. And remember, you guys can follow along at home on the charting. There's a link in the description in the TradingView. Click on it, sign up for free. You can do all the trading, all the charting that we do as well. Now, the reason I take you here instead of directly to the Fed funds rate is because the 2-year interest rate, it's affected more so than anything else by what the Fed funds rate is at. And remember, banks borrow short term, but they lend out long term. So a bank may borrow on a 2-year, like what's in front of us, but then lend out for the 10-year. That's why for banks to be profitable, an inverted yield where the 2-year Treasury is at a higher percentage rate than a long-term 10-year, they're not making their money. So it's not good for banks and financials. Okay, how does this all tie in now to rents? Well, while you're in a rental agreement, the rental contract, your price doesn't typically go up. Your percentage rate that maybe the landlord is using, it doesn't change. Your rent doesn't go up typically until you get to where you're renewing your lease, right? And then sometimes in a rental agreement, it'll say in there that, well, the landlord has the option to raise your rent by X percentage points, right? When you renew. Well, that rate increase that you may get when you renew your contract, it may state in there that it's allowed to change based on the current interest rate, right? And interest rates fluctuate all day long. With the trajectory of the 2-year and even the 10-year, both of them are rising, and they've been rising rapidly. I mean, look at the 2-year and the slope at which it has been rising here recently. Let me zoom in here. I mean, it's nearly straight up. When we were back here, our June 10th, June 11th, I mean, it literally went straight up. Here, it's not going quite as straight and parabolic, but it's still rising rapidly. Now, if your landlord is using what the current interest rate is when you renew your rental agreement, then yes, this can affect your rent. Or maybe a landlord who doesn't have anything in there about, renewing a lease. When you go to say, hey, I think we want to stay here for a couple more years. Can we renew our lease? And he may give you a new lease, or she may give you a new lease to look at and sign. And you may see that your rent payment has gone up. Well, why did the rent payment go up? Well, if the property appreciated and rents that are compatible, that are similar within the same area have also gone up, that can raise it. But the interest rate can also be a cause for why it goes up. So, yes, to your question, yes, it can affect rents. But typically, and there's always a possibility of some unknown, right, that I don't know about, some wacky deal. But typically, when you're in a lease or a rent, the payment is going to stay the same until you renew. Unless there's something within the rental or lease agreement that says otherwise. That's the common practice. So, again, yes to your question, but only when you're renewing a lease or renewing a rental agreement. That's when the rate increases could cause your rent to go up. Doesn't seem to even, let's see, can I swap them like this? Okay, so here's another thought too on rents. What if the property value of the place you are renting goes down, and at the same time, the comparables that are in the same area, same square footage, same amenities, pretty close in rent price, what if those property values also start to decrease? But interest rates have gone up. How would that affect a rent price? Well, if property values are going down, then typically the rent could go down. If interest rates are rising while property values are going down, rents could stay the same. And another scenario is if the rates are going up, but property values are going down, rents could go up a little bit. But typically, when you're in an environment of a rising rate, costs are rising with it, especially when you're buying. Especially when you're buying. But again, with rents, it is more of a lagging value. It takes a while for rate hikes that are happening right now to work their way into a rent, because again, and this is why, typically you don't see increases in your rental price until you renew. And that's when you can see the price change. And if property values have gone up, maybe interest rates have trickled up a little bit, then you're going to pay a higher rental price when you renew. So there's many factors when it comes to rent. And rent is also one of those lagging types of, what would be the right word to use here? Oh, I can't think of it off the top of my head, but it is definitely lagging behind the system. And that is something that can also affect CPI reporting under shelter. Because when it comes to the value of rent, it's the landlord saying, okay, well, the question to the landlord is, if you had to rent your property today, what would you rent it for? Well, most landlords look at, what it's currently being rented for, and, maybe they throw another $50 or $100 on top of that, or, maybe a percent or 2% or whatever the case may be. And that's the number they come up with. So just a guess, because it's lagging behind. Because the landlords, they're not thinking about what they could get today. They're thinking about what they are already getting for it. But if they renewed it today, the cost would go up because interest rates are going up, because the cost to borrow money has gone up. So it doesn't affect rents as severely as borrowing money directly, like for a new home. That's when it really affects you, and pretty instantly too. Okay. Hopefully that answers your question. Hopefully I did a good enough job with that one. Okay. So, well, we're here on the 2-year yield. It was up 0.16% today. It closed at 3.87%. That is just rapidly rising on the 2-year. And the 10-year, it was up a little bit too today. But the big change was the weekly change for the 10-year and the 2-year. But I'll come back to this in just a moment. There was something that I wanted to get to before we started talking about treasuries, and that was the selling was broad-based today. I just wanted to go back to the market right quick and just finish up this, the couple things I have here on my notes about it. Selling today was broad-based in nature, but stocks that were similar to FedEx, those like in the Dow Jones Transportation Index, they were affected way more than other stocks in the market. As a matter of fact, let's pull up the Dow Jones Transportation Average. The ticker symbol for that is DJT, where DJI is for the Dow Jones Industrial Average. DJT is the Dow Jones Transportation Average. It was down over 5% today. Look at this big gap that it left here. This is a huge gap. Looking back here, let's go back to the beginning of 2022. Where can we find on this chart a gap as big as today? Nowhere. Nowhere in the entirety of 2022 was there a gap left as big as today. All because of FedEx warning. Every component in the transportation sector suffered today, suffered losses. Big warning from FedEx. All right, let's look at the sectors here right quick. The 11 S&P 500 sectors here. Let me slide it down just a little. We get the dollar and semiconductors. Semiconductors I'll talk about. There's something important. Oh, excuse me. Something important I want to talk about with semiconductors. But 9 of the 11, we can count them up right there. 9 of the 11 S&P 500 sectors closed in the red. Only consumer staples, XLP, was up 0.3%. And real estate, XLRE is the ticker, up 0.03%. So basically flat. Basically flat. Those are the only two that could squeeze out a gain today. Now, if you're noticing, there's a third one on the bottom of that list that's green. That's semiconductors. Semiconductors did pretty decent. There was with the sector performance here, there was a risk-off mentality as the defensive-oriented healthcare, ticker symbol XLV, was down 0.3%, and utilities, very defensive, old school defensive, XLU was down 0.4%. They closed with some of the slimmest losses. Now, on the flip side of that coin, your big losses today were in energy, XLE, down 2.2%, and industrials. Whoa, Dow theory, industrials and transportation. If they're going down, that's not good for the economy because industrials build it, transportation ships it. So if the industrials are not building it, then there's nothing for the transportations to ship. Therefore, the economy can only go lower and get worse. Now, energy and industrials, they sank today. Again, energy 2.2% down, industrials XLI down 2.1%. They were at the bottom of the pack of this list here. Notably, though, small and mid-cap stocks. Did I say stocks? I meant stocks. They sold off more than their peers as the Russell 2000 was down 1.5%. And the S&P Mid-Cap 400, there's a lot of other smaller indices out there or indexes that you can dive into. But the Mid-Cap 400 was down 1.4%. They showed the steepest losses when you compare to the S&P 500 only being down 0.72%. Now, semiconductors. I want to talk about semis. Semiconductor ETF was green today. SMH is the ticker. It was up nearly 0.5%. Semiconductor stocks were actually one of the bright spots today. Van Erickson Semiconductor ETF, ticker symbol again, SMH, was up 0.5%. almost closing within its weekly expected move, a little bit off. It was at 203 where it closed. The weekly expected move was 208. Now, next Tuesday, a big component of semiconductors, NVIDIA, who hit a new 52-week low this morning. Let's pull this up here so you can see. It ended the day up 2%. But NVIDIA hit a new 52-week low. And I can't remember if it was the beginning of this week or last week when I lowered my buy box for NVIDIA and I said, I think coming soon you can get NVIDIA for under $125 a share. Guess what the low was today for NVIDIA? Its new 52-week low, $126 a share. Not quite the 125, but boy, did that get close. And I'm not done thinking, oh, well, we just missed it with NVIDIA. No, I think there's a lot of headwinds short term for semiconductors. Long term, they look great. The world's going to need more and more and more and more chips in the future. So long term looks great. Short term, I see some headwinds. Now, why am I bringing up NVIDIA? Well, it's 52-week low that it hit this morning. It's 2% gain by the end of the day. That was wonderful. But next Tuesday, September 20th, NVIDIA's CEO will give a keynote address at the GTC 2022 conference. Now, shares of NVIDIA have been active whenever the CEO goes out and talks, especially about NVIDIA's future. Other times that the CEO has talked at this conference, investors have been very enthusiastic about NVIDIA, and there's also been new bullish ratings from analysts. So, what's said this year is very important, especially in the context of what's happened recently with NVIDIA. Remember, the US government told NVIDIA, you can't sell this or that to China, to Russia. So hearing what the CEO of NVIDIA has to say, it will be important and investors will be listening. It could be all positive. Or maybe the CEO talks about these short-term headwinds. But long-term, the future looks great. So keep NVIDIA on your radar in the semiconductor index, ETF, on your radar for next week. I could see this thing not moving a lot, but I can definitely see it moving. Okay, now back to our sectors here. And I want to talk about energy real quick because I always do. And then I want to talk about the dollar after energy. So when we pull up energy today, down 2.1%, the energy complex futures, they were mixed today. Now, energy, funny enough, did close within its weekly expected move. I believe there were 2, maybe 3 sectors that did close within their weekly expected move. So that's a plus. That's a bonus. But when we talk about energy, oil is one of the biggest components when we talk about energy. So let me go in here. I do want to point out one thing. I read this afternoon a report about what analysts are bullish on in the short term. And I found it interesting because energy was at the top of the list. Now, I'd figured that maybe earlier this year, maybe springtime, sure, analysts could be bullish on oil, on energy. But right now, analysts are extremely bullish on energy and oil. What do they know? Maybe they have a theory similar to mine, where this energy crisis is going to affect and impact the cost of energy. And it's going to continue to rise. Let's look at oil. U.S. oil in TradingView. That'll get you there. Now, oil was up 0.3% today to $85 a barrel. It seems to be finding some pretty good support along that $85, $84 a barrel. Natural gas today, it was not up. It fell again, this time today, 6.2%. Natural gas has taken a pretty big hit over the past week. But here we are with oil. And you can see the green bar up here. This was our support level when it came back down in August and September. This was our support. But now there's a blue line down here. This is becoming our support. Somewhere between $84, $85 a barrel. Maybe that's the new support before it starts to rise, if the energy crisis does play a role in energy and the cost of energy. So just want to point that out. It is hanging there. It's at $85.28 a barrel. That's where it closed at almost today. Slightly off from that, but pretty darn close. Now, let's go back to the Treasury market real quick. US 0 to Y for the 2-year. Now, Treasury yields didn't do much today, but they did make sizable upside moves this week. And I mentioned this briefly earlier, almost straight up. Now, the 2-year did fall 2 basis points today. And is that lining up? Did I look at that right earlier? Yeah, I guess I did. I was looking at after hours when I mentioned it earlier, because it is slightly up in after hours. Okay. Here's the big number, though. If we take in the past week, all of these green candles here rising up above this one-time resistance line, the 2-year rose 28 basis points to 3.85% this week. It rose 28 basis points this week alone. I mean, we got to go back to the beginning of August or the middle to beginning of June to find another time where it rose as quickly as it did. And then the 10-year, US 10Y as the ticker. The 10-year fell 1 basis point. Like I said, Treasuries didn't do much today. But over the past week, the 10-year was up 13 basis points to 3.45%. It is just steadily up and to the right. And it's really, 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 really close to taking out this high. Let's see. Did it do it? Let's see. 3.49. Let's see, 3.49. 3.49. Oh, now I got to go to the tenth of a percent to see. 3.497 and 3.490. So not quite 0.7% away from that high that was set back on June 14th when the market hit its bottom. So with the 10-year spiking like this, this puts pressure, especially on the technology sector, right? Pushing it down. That's why the Qs were down so much today, right? Well, if they get off the accelerator here and the 10-year stops rising, well, then that could be good for the equity market, and maybe the equity market could start coming back up, giving us a rally. But the 2-year, the 10-year especially, they're going to have to pause in order for that to happen, okay? Now, looking at the dollar, again, when the dollar is strong and it has a fast rate of change, then usually equities, especially the S&P 500, move in the opposite direction. Well, the dollar didn't do much today. It was down 0.1%. It's still at 109.6. That's where it closed. It got to a high of 110.2 today. I believe this dollar is just contracting right now, getting ready for another expansion, another strong move up. And when the dollar moves up, the S&P moves down. So I said yesterday in the live stream that I think the dollar is ultimately, it's got to be getting close here. It breaks above 110. It's got to be getting close to some sort of conclusion to this year-long rally, right? 2022 has been one heck of a year for the dollar to rally. And I got to expect a conclusion soon, but I'm not sure when. But I do think the conclusion will be similar to a blow-off top, which could capitulate the S&P 500 and equities down. That's what I'm thinking. Okay. Looking back at some of today's economic data. We got the preliminary September University of Michigan Index of Consumer Sentiment. It checked in at 59.5. The expectation was 60. So a half a point off of the expectation to the downside. Now, the final reading for August was 58.2. So this preliminary reading showed consumer sentiment improved a little. In the same period a year ago, though, the consumer sentiment, it stood at 72.8, much higher than today. Now, the key takeaway is that the consumer sentiment has stopped deteriorating, aided by the drop in gasoline prices. However, the report indicates that the uncertainty over short-term inflation is the highest it has been since 1982. Short-term inflation on the consumer's mind. We have to go back to 1982 to find it comparable. Gas prices have come down. Will they stay down during the winter? Was it Janet Yellen the past week said that she expects oil prices, gasoline prices to rise this winter due to the energy crisis in Europe? She either said that earlier this week or she said it at the tail end of last week, but she said it. Okay. Looking ahead to Monday, economic data is limited to the September NAHB housing market index. The expectation is a 48. The prior reading was a 49. 1 point difference. Not anything that's going to shake the markets. That comes out at 10 o'clock a.m. Now the week as a whole next week could have some support from the recent trend in the stock market bouncing back from the extra volatility seen with the expiration of options today. But the S&P, it had that resistance today at about 3880. Support at 3,900, resistance at 3,880. That's not a lot of wiggle room. Or I said that kind of backwards. 3,880 is under 3,900. Come on, man. The support that we had past tense had at 3,900, but then the resistance that we saw lower at 3,880 gives me pause on whether we can really see a rally, a sustained rally, or not. Now, it is very possible we could see a rally on Monday to get back some of what we lost this past week. I do think that's a high probability. I also think that leading into the 21st, the market's kind of going to be calm. Typically the day before rate hikes, the market is somewhat calm. Doesn't move a whole lot. So that can be expected next week. Now, I also dug up, and this is something that's a little bit counter to what I read earlier from the Stock Traders Almanac at the very beginning. But I saw another piece, completely different publication, that said the S&P 500 has gained 6 of the last 8 post-option expiration weeks and the spread between the performance in the weeks before options expirations and the week after options expiration. It's been reported the widest difference since 1990. But yet, the Almanac says that since 1990, there's been a higher chance, and there's only been 4 times where the market has been in the green from now until the end of September. So what I'm getting from these 2 points of views are that next week there could be a little green, like maybe Monday. Maybe Jerome Powell doesn't shake up the rooster's nest too much, and he sticks to what he says at Jackson Hole, and maybe we could rally a little bit on Thursday, Friday, the end of the week. So maybe that's what I can get out of those 2 reports. I don't want to call them reports, but historical data. Let's call it that. But then, I don't know, the tail end, the very last week of September, then is very harsh to the downside. I think that's my takeaway from those 2 historical data points that we have to look at. Okay, now, although the big driver for next week, outside of what historical data says, is definitely going to be the Federal Reserve's Policymaking Committee meeting and its announcement on its decision on interest rates. That'll be on Wednesday, September 21st at 2 p.m. First is the press release at 2 p.m. Eastern. And then 30 minutes later at 2:30 p.m. Eastern, Jerome Powell will hold his press conference. And that is where the wild card is for next week. Okay, that's the end of my list. I hope you enjoyed it. Please do me a favor, click the like button and share this video with a friend. That really helps out a small channel like this. And I know you hear YouTubers all over the place saying, click that like button, subscribe to the channel, leave a comment, do all those important things. I know it's cliche at this point, but it really is important. Honestly, it is. And of course, if you have any questions, leave them in the comments and we will go over them. Now, if you like this perspective, you want more, we had a big piece that we put out earlier this week when we did not do the live stream for our private investor community that really gives you a full-blown bird's eye view of what's going on in the market and what is likely, what has the highest probability of taking place in the market. If you would like that perspective, click the first link in the description and you can get it all there. Our weekly expected moves on 40 products, and we're growing that list. Our top 10 stocks in categories like value, dividend, growth, momentum, and of course, commentary on economic data, numerous trade setups throughout the week, all to help you become a better investor, a better trader. So click that first link in the description of this video if you haven't already. And for those that are in our private investor community, I greatly appreciate each and every one of you. You, ladies and gentlemen, are why I can do this. So thank you all so very much for watching. You are very welcome. I hope the information shared in these videos can help you, obviously, become a better investor and a better trader. That's the whole goal. So have a wonderful weekend. Our investor community, I will see you in our writings throughout the weekend, weekly expected moves, Sunday evening, and then back again live after the market has closed on Monday to talk about what happened, why it happened, and what to expect going forward. So thank you for spending your Friday evening with me. I greatly appreciate it. Or if you're watching on Saturday, happy Saturday. Have a good weekend. I'll see you in the next video. And you, my friend, be good.